29%. That's the average interest rate on store credit cards in 2025. To put that in perspective, if you carry a $3,000 balance, you're paying nearly $900 a year just in interest before you've paid down a single dollar of what you actually owe. I'm going to walk you through exactly how store credit card interest works, why these rates are so much higher than regular credit cards, and most importantly, how to make informed decisions about whether these cards make sense for your financial situation. By the end of this video, you'll understand the mathematics behind APR calculations, the psychological tactics retailers use at checkout, and practical strategies to use these cards smartly if you choose to get one. But first, let me introduce you to someone who learned all of this the hard way. Meet Mike. Last November, he bought a $1,000 TV with a store credit card. He got 20% off, saving $200. Great deal, right? But over the next 6 months, while paying minimums, he paid $174 in interest. His savings just vanished into interest charges. Here's what most people think. Store credit cards are just like regular credit cards, maybe with a few extra perks. But the reality? They're fundamentally different financial products with very different cost structures. Quick important note before we dive in. This is educational content, not financial advice. I'm showing you how these systems work so you can make informed decisions. Always consult with a financial professional for your specific situation. Now, let me show you exactly what's happening behind the scenes when you swipe that store card. This isn't about vilifying retailers. It's about understanding the business model. Store credit cards are profitable for 3 specific reasons, and once you understand them, everything clicks into place. First, the discount they offer you? It's almost always smaller than their markup. A furniture store might mark items up 50 to 70%. Offering you 20% off and getting you to open a credit card is still profitable, especially if you carry a balance. Second, the interest rates. According to data from the Consumer Financial Protection Bureau, the average store credit card APR in 2025 is 28.93%. Compare that to the average regular credit card at 20.72%. That's an 8 percentage point difference. Third, and this is the key, statistics show that approximately 74% of customers who open store credit cards during a promotional period don't pay off the balance before that promo ends. That's when the real revenue starts. Let me give you a concrete example. Sarah buys a $2,000 bedroom set with a store card offering 12 months no interest. Sounds perfect, right? She plans to pay it off in time. But life happens. A car repair, medical bill, her hours get cut at work. Month 13 hits, and suddenly she's being charged 27% interest, not just on her remaining balance, but sometimes on the original purchase amount depending on the card terms. Over the next year, she pays $300 in interest. The 15% discount she got, $300, is completely gone. The mathematics tell the story. These aren't arbitrary numbers. They're based on real consumer behavior patterns and actual credit card data from 2024-2025. Hi, I'm here to break down the actual mechanics of how this works, because understanding the math is what gives you power over your financial decisions. There are 3 critical components most people don't fully understand about store credit card interest: how APR gets calculated daily, what deferred interest really means, and why the minimum payment is designed the way it is. Let's start with APR, annual percentage rate. The word annual is misleading because the interest is actually calculated daily. Here's how it works. Your 29% APR gets divided by 365 days. That's about 0.079% per day. Sounds tiny, right? But it's compounding. Every single day, interest gets added to your balance, and the next day, you're paying interest on that interest. Second component, deferred interest versus zero interest. These sound similar but are drastically different, and retailers know most people don't read the fine print carefully enough to spot the difference. Let me show you exactly what I mean. Now, here's what makes deferred interest particularly tricky, and why reading the specific terms is absolutely critical. Let's say you get a furniture store card with 12 months no interest. In many cases, that's actually 12 months deferred interest. The difference? With true 0% APR, interest isn't charged during the promotional period. If you don't pay it all off, you only pay interest going forward on the remaining balance. But with deferred interest, which is more common than most people realize, if you don't pay off every single penny by day 365, all that interest that was waiting in the wings gets added to your balance retroactively. Imagine owing $2,000, paying off $1,900 over 12 months, then month 13 hits, and suddenly you owe not just the $100 remaining, but the $100 plus $580 in retroactive interest that was being calculated the entire time. That's the deferred interest trap. According to a 2023 Consumer Financial Protection Bureau study, about 60% of store credit card promotional periods use deferred interest, not true 0% APR. The terms are in the contract, usually in smaller print, often labeled "no interest if paid in full." That phrase is your clue. It means all the interest is waiting, $1 short, 1 day late, and it all hits your account. Here's the insider knowledge. The minimum payment calculation is specifically designed to keep you in debt longer. On a $2,000 balance at 29% APR with a 2% minimum payment, you'd pay over $4,000 in interest over 28 years if you only made minimum payments. That's not a mistake in the design. That's the feature working as intended from the business perspective. Every day, millions of Americans make decisions at checkout counters. The system isn't designed to trick you, but it is designed to be profitable. Understanding how it works is the first step to using it strategically instead of being used by it. Now, here's what most financial advice videos don't tell you. Because it's complex and nuanced, but it's crucial. There are actually legal frameworks and specific tactics retailers use that are completely above board and disclosed, but easy to miss if you don't know what to look for. What I'm about to show you will change how you read every credit card offer you receive. The patterns become obvious once you see them. Let me walk you through the evidence, because transparency matters here. According to the Consumer Financial Protection Bureau's 2024 report on store credit cards, the average APR increased from 26.5% in 2020 to 28.93% in 2024. That's a 2.43 percentage point increase in just 4 years. The Federal Reserve's data shows that total store credit card debt in America reached $186 billion in 2024, with the average cardholder carrying a balance of $1,841. Here's the timeline that matters. In 2018, typical store card APRs ranged from 23 to 25%. By 2020, that rose to 25 to 27%. By 2024, we're seeing 28 to 31% as standard, with some premium retail cards hitting 32.99%. The connection? Interest rate environments. As the Federal Reserve raised rates to combat inflation, credit card companies adjusted their rates upward, but they were slower to lower them when Fed rates stabilized. Now, here's a real pattern from credit card agreement analysis. Approximately 60% of store credit cards use deferred interest promotional periods. Only about 40% use true 0% APR. How can you tell which is which? The language. No interest if paid in full equals deferred. 0% APR equals true 0. One more documented pattern: payment allocation. When you have both a promotional balance and regular purchases on the same card, federal law requires payments above the minimum to be allocated to the highest interest balance first. But minimum payments? Those can go to the lowest interest balance, meaning your promo balance sits there while interest gets calculated in the background. This isn't theoretical. This is how the contracts are structured, and it's all disclosed, just not in language most people parse carefully. Now, here's what most financial advice videos don't tell you, because it's complex and nuanced, but it's crucial. There are actually legal frameworks and specific tactics retailers use that are completely above board and disclosed, but easy to miss if you don't know what to look for. What I'm about to show you will change how you read every credit card offer you receive. The patterns become obvious once you see them. The evidence is clear. These are legal financial products with specific structures that benefit the issuer when used a certain way. Your power comes from understanding those structures. But here's the part that affects you directly, right now. If you have a store credit card, or you're thinking about getting one, there are specific actions you need to take in the next 24 hours to protect yourself from these patterns. And there are actually smart ways to use these cards that flip the script entirely. Let me show you exactly what I mean. Here's what this means for you specifically, and why it matters more than you might think. Your financial health is affected in 4 key ways by how you use, or don't use, store credit cards. First, credit utilization. If you max out a $1,000 store card, that's 100% utilization on that account, which can drop your credit score by 20 to 50 points even if you're making payments. This affects your ability to get car loans, mortgages, even apartment rentals. Second, opportunity cost. Every dollar you pay in interest is a dollar you can't save, invest, or use for emergencies. If you're paying $75 a month in store card interest, that's $900 a year, which could be an emergency fund, retirement contribution, or paying down higher priority debt. Third, the debt spiral. Store cards often lead to other store cards. You get one at the furniture store, then the electronics store, then the department store. Suddenly, you're managing 5 accounts, 5 minimum payments, 5 high interest rates. The cognitive load alone is exhausting. Fourth, future financial access. When you apply for a mortgage or car loan, lenders look at your total debt-to-income ratio and your credit mix. Multiple high-interest store cards with balances can make you look like a risky borrower, leading to loan denials or higher interest rates that cost you thousands. Think about your current situation. Do you have a store credit card? Pull out your last statement right now. Look at 3 things: your APR, your minimum payment, and how much of that minimum is going to interest versus principal. That tells you everything. Are you experiencing stress about making minimum payments? Have you noticed your credit score dropping? Are you avoiding checking your balances? These aren't personal failures. They're symptoms of a system designed to maximize revenue from cardholders who carry balances. The good news? You're not stuck. Understanding the mechanism is step 1. Taking action is step 2. This is the reality for millions of Americans. But here's the truth. The system has rules, and once you know them, you can play by them, or choose not to play at all. Let's talk about your options. Okay, here's the empowering part. You have 5 specific strategies you can use starting today, whether you already have store credit cards or you're deciding whether to get one. Strategy 1, the promo period calculator. Before you accept any promotional offer, divide the purchase amount by the number of months in the promo period. That's your minimum monthly payment to pay it off interest-free. Can you afford that amount every single month? If not, the promo isn't worth it. Example, $1,200 purchase, 12-month promo. You need to pay $100 a month minimum. Can you do that? Yes equals proceed. No equals don't open the card. Strategy 2, the auto pay setup. If you do get a store card for a major purchase, set up automatic payments for the calculated amount immediately. Don't trust yourself to remember. Remove the human error factor. Strategy 3, the deferred interest check. Before signing, ask one question. Is this deferred interest or true 0% APR? If the salesperson doesn't know, ask to see it in writing. Look for the phrase, no interest if paid in full. That's your red flag for deferred interest. Strategy 4, the credit utilization rule. Never use more than 30% of your available credit limit on any card, including store cards. It protects your credit score and creates a safety margin. Strategy 5, the opportunity cost analysis. Before opening a store card for a discount, calculate this. Discount amount minus potential interest if you don't pay in full. Is it still worth it? Be honest about your payment likelihood. I'm not giving you financial advice. I'm showing you the tools that informed consumers use to make decisions that work for their situations. Always consult with a financial advisor for your specific circumstances. So now you know how store credit card interest really works. The mathematics, the psychology, the business model, and most importantly, how to make informed decisions about whether and how to use these cards. The question is, what will you do with this information? I want to hear your experience in the comments. Do you have a store credit card? Have you successfully used a promotional period? Or did you get hit with unexpected interest? What's your strategy? Let's learn from each other. If you found this valuable and think more people should understand how credit actually works, please hit that like button and share this video. Real financial literacy can change lives. Subscribe if you want more content breaking down financial systems in plain language. No jargon, no judgment, just information that helps you make better decisions. And if you want to understand how regular credit cards work differently, including rewards programs, balance transfers, and credit score impacts, I've got a video that breaks down everything you need to know. Check the link in the description. Thanks for watching. Stay informed, stay empowered, and remember, knowledge is the best investment you can make.